pull up a chair, and pour yourself a fresh cup of coffee. Because we need to have a serious, family-style conversation about what is sitting on your kitchen table right now. If you have your 2025 tax forms in front of you, or if you are about to head out to see your accountant, I need you to pause for just a moment. Do not sign anything. Do not file anything. Not until we talk about line 12. For the last 10 years, I have heard the same complaint from every single one of you in the comments. And frankly, I've agreed with it. You've said, I worked for 40 years, I paid my taxes, and now that I'm retired, inflation is killing me, and the tax code treats me like I'm still 30 years old. You were right. The standard deduction, while helpful, never really accounted for the unique costs of aging, the health care, the prescription drugs, the higher utility bills because you're home all day. But this year, for the filing season that just opened this week, the game has officially changed. The ink is dry on the new tax forms, and hidden inside the complex legislation of the One Big Beautiful Bill Act, which we are just going to call the OBBA to keep it simple, is a provision that is specifically designed for you. It is a brand new, stackable, verifiable tax deduction of $6,000 for every single American over the age of 65 who meets the income requirements. And if you are married, that number doubles to $12,000. I want to be crystal clear about what this is. This isn't a credit you have to apply for. This isn't a stimulus check that might get lost in the mail. This is a hard-coded reduction in your taxable income. It means the first $6,000 of your pension, your interest, or your part-time wages is effectively invisible to the IRS. When you combine this with the standard deduction we already have, we are looking at a historic level of tax protection. But, as with everything involving the government, there is a catch. There are income cliffs. There are phase-outs. And right now, there is a massive debate raging online about who actually deserves this money. In the next few minutes, I am going to walk you through the fine print. I'm going to show you the modified adjusted gross income limits that might disqualify you if you aren't careful. I'm going to show you how this deduction stacks on top of your medical expenses if you itemize. And we are going to talk about the controversy. Why some people say this deduction is a lifeline, and others say it's a trap for the middle class. Let's get into the numbers. The supersized standard deduction. First, let's verify exactly what you are entitled to this year. If you are filing as a single person and you were 65 or older by December 31st, 2025, you already know you get a slightly higher standard deduction than a 30-year-old. That's old news. But under the ABBA, you now get an additional senior bonus of $6,000. Here is the math you need to write down on a notepad. The base standard deduction for 2026 is roughly $16,100. The traditional age 65 add-on is about $2,050. And now, the ABBA senior deduction adds another $6,000. When you add those three numbers together, a single senior can now earn over $24,150 before they owe a single penny in federal income tax. Now, let's look at married couples, because this is where the numbers get truly staggering. If you and your spouse are both over 65, you get the base married deduction of roughly $32,200. You get the traditional age add-on for both of you, which is about $3,300 total. And now, you get the ABBA deduction of $6,000 each. That is $12,000. Add that up. $32,200 plus $3,300 plus $12,000. That is $47,500. Let that sink in. A retired couple can have $47,500 of ordinary income, pension, interest, wages, and their federal tax bill is zero. For millions of you watching this effectively ends your relationship with the IRS. If your total income is $45,000, you are done. You file the return to prove it, and you pay nothing. This is the historic relief that the sponsors of the bill promised. But we have to talk about the people who are being left out, because this is where the anger is coming from. The means test trap. The authors of the ABA decided that this deduction should only go to middle-class and lower-income seniors. They didn't want millionaires getting an extra $6,000 write-off. So they created a means test, or what tax pros call a phase-out cliff. Here is the rule. If you are single and your modified adjusted gross income is $75,000 or less, you get the full $6,000. If you are married and your joint MAG is $150,000 or less, you get the full $12,000. But what happens if you make $75,001? This is where it gets tricky. It is not a hard cliff where you lose everything instantly, but it is a steep slide. For every dollar you earn over the limit, the deduction is reduced by 6 cents. The reduction formula is aggressive. By the time a single senior hits $175,000 in income, the entire $6,000 deduction is gone. It completely vanishes. This has created a lot of anxiety for seniors living in high-cost states like New York, New Jersey, or California. I was reading a forum post yesterday from a retired teacher in Long Island. She has a pension and Social Security, and her income is exactly $78,000. Because she is $3,000 over the limit, her deduction is getting slashed. She wrote, "I don't feel rich. My property taxes are $12,000 a year. Why am I being punished for having a pension?" This is the online debate I mentioned in the title. There is a fierce argument happening right now. On one side, you have people saying, if you make $75,000 as a single retiree, you are doing fine. You don't need a tax break. On the other side, you have seniors saying, in 2026, $75,000 is not rich. Inflation has destroyed the buying power of that money. This limit should be $100,000. Wherever you stand on that debate, you have to deal with the reality of the math. If you are close to that $75,000 or $150,000 line, you need to be very, very careful this month. Did you sell any stock? Did you take an extra withdrawal from your IRA to buy a car? That extra income might have pushed you over the phase-out line. If you are doing your taxes and you see that your $6,000 deduction has shrunk to $4,000, check your magi. That is the culprit. The stackable secret for sick seniors. Now, I want to share a piece of good news that most people are missing. Usually, the IRS forces you to choose. You either take the standard deduction, or you itemize. You pick the bigger one. But the ABA deduction is unique. It is stackable. This means that if you have high medical expenses and you choose to itemize, you can still claim the $6,000 senior deduction on top of your itemized deductions. This is a game changer for seniors in nursing homes or those fighting cancer. Let's say you are single and you spent $30,000 on nursing home care this year. Obviously, you are going to itemize because $30,000 is way higher than the standard deduction. In the old days, that was it. You deducted the $30,000. But this year, you deduct the $30,000 for medical care, and you add the $6,000 ABA deduction on top of it. Your total deduction becomes $36,000. This is a massive subsidy for sick seniors. It effectively makes $6,000 of your income tax-free to help pay for that care. If you are filing for a parent in a facility, or if you have high medical bills yourself, please make sure your accountant knows this. Do not let them tell you you can't have both. Under this specific new law, yes, you can. The Social Security Stealth Fix. I want to talk about the tax torpedo again, because this deduction interacts with Social Security in a very interesting way. We all know the hated thresholds, $25,000 and $32,000. If you earn more than that, your Social Security becomes taxable. The ABA did not change those thresholds. That's the bad news. However, this new deduction acts as a stealth fix. Think about it. If your income is $40,000, the IRS formula says 50% of your Social Security is taxable. So, on paper, you have taxable income. But then, you apply the new supersized standard deduction of $47,500. What happens? The deduction swallows the income. Even though your Social Security was technically taxable, the deduction is so large that it wipes out the tax liability anyway. So, in practice, this deduction has eliminated the tax on Social Security for about 70% of the retirees who were paying it. It didn't change the rule. It just overpowered it. This is why I tell people, don't panic when you see taxable benefits on line 6B of your tax return. Look at line 12. Line 12 is the hero of the story. It is the eraser that wipes line 6B clean. The expiration date warning. I have to give you the bad news now. This law is temporary. When Congress passed the ABA in July 2025, they used a process called reconciliation. I won't bore you with the politics, but it means the law has an expiration date. This $6,000 deduction is valid for the tax years 2025, 2026, 2027, and 2028. On January 1st, 2029, it vanishes. Unless Congress acts to extend it, we are going to fall off a cliff in 3 years. Your taxes will go up automatically in 2029. Why am I telling you this now? Because you have a 3-year window to take advantage of this. If you have a traditional IRA, you should look at filling the bracket. If you have $47,500 of tax-free space, and your pension and Social Security only come to $30,000, you have $17,500 of unused tax-free space. Don't let it go to waste. Pull $17,000 out of your IRA. It will be tax-free because of the deduction. Put it in a savings account. Put it in a Roth. Just get it out of the taxable account while the window is open. In 2029, when the deduction disappears, you will wish you had taken that money out tax-free when you had the chance. Talk to your financial advisor about tax bracket filling for the next 3 years. The State Tax Trap 1 final warning before you file. This $6,000 deduction is a federal law. It applies to your IRS return. But what about your state return? This is where it gets messy. Most states conform to federal law, meaning they copy the federal deductions, but some states do not. States like California, New Jersey, and Minnesota often decouple from these special tax breaks. This means you might fill out your federal return and owe zero tax because of the $6,000 deduction. Then you fill out your state return, and the state says, "We don't recognize the ABA deduction." Suddenly, you owe the state $500 or $1,000. Do not spend your federal refund until you have finished your state taxes. You might need that federal money to pay the state bill. Check your state's Department of Revenue website this week. Search for Conformity to ABA Senior Deduction. You need to know if your state is playing along or if they are opting out. Action plan for filing week. So, here is your game plan. You are going to go to your tax appointment or open your TurboTax and you are going to look for line 12. If you are single and over 65, that number needs to be over $24,000. If you are married and over 65, that number needs to be over $47,500. If the number is lower than that, stop. Ask why. Did the software miss your birth date? Did it miss the ABBA checkbox? Do not accept a standard deduction of $16,000 or $32,000. That is the under 65 rate. You earned the over 65 rate. Verify the income limit. If you are over $75,000 over $150,000, expect the number to be smaller. That is the phase-out working correctly. This deduction is a win. Is it perfect? No. The income limits are tight and the expiration date is looming. But for this year, right now, it is money in your pocket. It is relief from inflation. And it is the law. Make sure you claim every penny of it. I'll be watching the IRS updates closely this week. If there are any glitches in the system, or if they release new guidance on the phase-out, I will post an emergency update right here. Until then, get your papers in order, check line 12, and don't let the IRS keep a dime more than they are owed. I'll see you in the next video.